The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
We're back to find out the secret to making money. All you have to do is buy low and sell high. Sounds easy, right? Not so much. The average investor lets their emotions get in the way. They want to buy when things are high because everyone's feeling good about making money, and they tend to want to sell when things are low, and that's a recipe for disaster. With me today from Raymond James is Senior Vice President, Private Client Strategist, and Portfolio Manager, Ryan Luenza. Welcome, Ryan. Thanks for coming.
Oh, thanks for having me.
So what got you interested in this business in the first place?
Well, that would probably be my dad. Early on, got me into finance. He's a financial advisor in the industry as well. And I've just always, from a very early age, had a real passion for finance. I feel like it's something that you're always learning, and it's just an exciting industry to be in.
Now, were you one of those kids that at a very young age started saving your own money, or did you wait till later in life?
Oh no, it started very, very early. I remember just even from paper routes, saving all whatever money was left over and saving for university. So it was an early thing that I started with.
So you saved to pay for your own university?
I did.
Now, how did that make you feel?
Empowered.
One of our other episodes, we're talking about that, so that's great to hear.
Well, I think you want to have some skin in the game, right? And so I think if you're contributing to your own university education, you're incentivized to work that much harder.
And you know, people need to take more control of their finances. Too often they leave it to others, or they have their head in the sand. And it's a really challenging time right now because interest rates are so low. So do you think investors should consider dividend-paying stocks?
100%. We are strong believers, long-term believers, that high-quality dividend-paying stocks is really the place to be on a long-term basis. And part of that is because of these very low yields in fixed income. So a little bit of background here. So as a result of the financial crisis, the central banks around the world lowered interest rates to near record lows. And that brought down yields in government bonds, in GICs, and corporate bonds. And so yields are very low there.
I mean, you're looking at getting anywhere from 0 to 2% on guaranteed fixed income products.
In Germany, you're getting minus 0.5% for 7 and 10-year bonds. You're actually losing.
Are you kidding? So you actually have to pay someone to hold your money?
Correct. If you bought a Swiss government bond today, you would be losing money on a 10-year investment. Unbelievable. So this really reinforces the importance of dividend-paying stocks. So first point is that dividend yields on major indices are above bond yields. So just take a look at the TSX. Right now, the dividend yield on that index is about 2.75%.
Okay, so if I buy some good quality, you know, names that people know on the Canadian stock market, I'm going to get paid a higher dividend to hold that than I will get paid when I own fixed income.
Correct. Take a look at your banks, Canadian banks. High quality, well-managed Canadian banks are yielding about 3.5% to 4%. Now that's before tax, right? On an after-tax basis, because dividends are taxed at a lower rate, your net yields are even higher relative to fixed income.
Well, I always hear people, you know, complaining about the fees that their banks are charging them. I always like to counter that by, don't complain. Buy stock, buy shares in the company.
Correct.
You can participate in all those profits that they're making.
The old Buffett, buy what you know, right? And so with fees, the banks make good profits, which they turn around and return that capital to shareholders, and not only good high yields, but growing dividend yields. And that's a key point. So a lot of the times investors make the kind of novice mistake where they just go out and they buy the highest dividend yield stocks. Oh, they look in the Globe and Mail, this stock's yielding 12%. But there's a big problem with that. The odds are that's not sustainable. They may cut that dividend. So you don't want to just go out and buy the highest dividend yield stocks.
Well, I mean, the old saying, if it sounds too good to be true, it probably is.
Exactly.
That does apply.
100%.
And you know, when it comes to stocks, a lot of people don't understand. The average investor, I think, reacts to stocks as, ooh, scary, risky.
Right.
They don't really understand that not all stocks are created equal.
100%.
And you still have to pick the right ones and be smart with what you do with your money. But like you say, you know, bank stocks or utilities or a lot of the big name companies that they know, you're basically getting a return on the profits that that company is making.
And it reinforces the point of high quality. Okay, you really want to buy high quality stocks over the long run. So as these companies deliver sustainable, solid earnings growth, they return that capital through dividends and dividend growth. So, for example, let's take a look at one name, TD Bank. Okay,
Yes.
that's a high-quality Canadian bank. Currently yields 3.8%. But the key with TD Bank is that they have grown their dividend at 9% each year for the last 5 years.
So you're getting a raise every year.
Exactly. Exactly.
And you're getting paid while you wait for the share price to go up.
Correct.
So the share price on TD Bank has gone up over the years
Correct.
as well.
Yes.
Of course, in the financial crisis, it went down.
Yes.
So that's the thing investors need to be careful of. They need to be aware that when they buy a stock, it's not always going to go up, up, up. It goes up and down and up and down and up and down.
Yeah.
But over time,
Perfect.
a well-diversified stock portfolio should do well.
Yes, absolutely.
Now, you talked about high yielding and how bad that is. I'm sure you've made a few mistakes over the years. Nobody's perfect.
Yes.
What was your biggest mistake?
Well, this goes back to the high yield. So many years ago, I used to cover preferred shares for the Canadian preferred share market. And I remember Yellow Pages. Okay, so it was issued at $25, as all preferred shares are. And it declined down to $17. And I remember thinking, this is a great deal. It's providing a high dividend yield.
You could buy it at 17 instead of 25.
Exactly. And so I remember I put out a note to our clients that you should start buying these because this is a very attractive security and investment. Well, little did I know the problems at Yellow Pages turned out to really, pick up. And they actually resulted in a restructuring of that company and the dividend got cut. And so that goes back to my earlier point before. I made that novice mistake. I focused on dividend yield, this high dividend yield, but I didn't realize that there was changes going on in this company. So that was the lesson that I learned in that.
You mean you couldn't predict that the Yellow Pages nobody would use anymore?
Well, but the funny thing was I was looking at media, they were doing this online stuff, but I missed that the underlying business.
Yes.
And this goes back to the high quality issue. I didn't pick up on the underlying main part of this business was going away, right? The physical Yellow Pages. And again, I had the signal, the market was telling me something. The yield was so high. I mean, Yellow Pages common equity was yielding north of 10%. So I didn't learn from that, or I made a mistake there, but I learned the lesson. Avoid those stocks because odds are they're going to cut that dividend.
And for those people who can think they can predict what's going to be the best performing sector, they can't, can they? Diversification is really important. I think you have a chart to show this. So how many people think that they can predict? I want you guys out there watching to tell me if you can guess what's the next performing sector. Now have a look at this chart that Ryan brought. Does that make sense?
So this chart that I've included here, what it does is it looks at sector returns of all the 10 different sectors in the TSX each year. What were the returns? And you'll notice that it's all over the map. One year it's utilities outperforming, the next year it's materials outperforming, and it's really hard to kind of figure out which ones are going to be outperforming from year to year. And so what this chart, this very busy chart, reinforces is diversification. Not only do you need diversification across asset classes, so while we still very much like dividend-paying stocks, you still need some bonds. You want to diversify across sectors. You want some utilities, you want some banks, and you want some energy.
And we can save all of that for the financial advisor to help work with the client to get those answers. Thank you so much, Ryan. We've touched on a huge topic, and we're not going to be able to get through even half of what I would have liked to have gotten through. But I really appreciate your time today.
Oh, thanks for having me.